Imagine that Natalie wants to buy a pair of beautiful new shoes. Can she afford the shoes? She has $300 in her wallet, and she knows that she has $700 in the bank. The sum is $1,000. Does this mean that she can afford the shoes? Of course, she needs to consider her other upcoming expenses as well as income for the rest of the month. Let us have a look. Phone and internet, $100. Food, $500. Home insurance, $90. Entertainment, $200. Car petrol and insurance, $200. Rent, $2,600. Fortnight salary, $3,000. Overall, future expenses are $3,690, and income will be $3,000. This means that she needs to put aside $3,690 minus $3,000, which is $690. While she has $1,000 in cash, only $1,000 minus $690, which is $310, are available. She cannot afford the shoes, since their cost is $400. In summary, there is a difference between how much cash one has and how much one can spend. Insurance companies must perform such calculations all the time. In such a context, the $1,000 might be the company's assets. The $690 are its actuarial reserves, how much one needs to put aside for future net expenses. The difference of $310 are its free reserves. Note that this is a very simplified balance sheet. Normally, there would be other types of liabilities, and the structure of assets would be much more complicated than just cash. Calculating actuarial reserves is a very important task for actuaries. These reserves typically correspond to very large amounts of money because premiums are always paid before the cover is offered, in advance. Claims or benefits can be large and are sometimes paid years or decades after the premium is received. In principle, calculating reserves is easy. One needs to consider the difference between future outflows and future inflows. In an actuarial context, this is complicated by the time value of money. Cash flows occur at different dates. Uncertainty, whether cash flows occur, when, and for how much, are generally all uncertain. Because of those uncertainties, appropriate probability models must be developed, and a margin is added to the actuarial reserves, which depends on the riskiness of the company's outstanding liabilities, and also other sources of risk. How to calculate this margin is normally regulated by government authorities, but a fair amount of actuarial judgment is always required. The reserves, expected value and margin must be certified by an actuary. The actuary must often make subjective choices, but she must always follow the regulator guidelines as well as actuarial professional standards in the relevant jurisdiction.